For over 20 years, Elon Musk insisted his rocket company would stay private until humans were regularly flying to Mars. But on June 12, 2026, that timeline completely vanished. SpaceX entered the public market. This chart shows the sheer scale of the IPO. At a fixed price of $135 a share, the company raised $75 billion in a single day. That's roughly triple the previous record holder, Alibaba, set in 2014. Wall Street listings of this magnitude almost always prioritize institutional banks. SpaceX bypassed that tradition entirely, setting aside 30% of its shares directly for everyday retail investors through brokerage apps. Opening the floodgates to everyday buyers triggered an immediate rush. Total buy orders exceeded $250 billion. The stock opened at $150, briefly pushing the company's valuation past the $2 trillion mark at trading volumes outstripping Apple, Microsoft, and Nvidia combined. It was an absolute frenzy of market mania, fueled heavily by giving average people direct access to a highly coveted tech stock. After spiking to $225, the stock pulled back 27%, settling near $160. This cooling off mirrors the accounting. Despite generating $19 billion in revenue last year, they posted a net loss of $8.7 billion. A business actively bleeding nearly $9 billion a year is being treated by Wall Street as if it is worth $2 trillion. The numbers on their face contradict each other entirely. To understand how unusual this is, we have to look at the other members of the $2 trillion club. Generally, companies that reach this tier share a specific set of financial traits: highly predictable, massive revenue streams, and equally massive net profits. Take Microsoft, for example. Its multi-trillion-dollar valuation is anchored by hundreds of billions in annual revenue, resulting in tens of billions in actual, realized net profit every single quarter. Amazon follows a similar pattern. Even with its massive infrastructure costs, its global logistics network consistently delivers billions in high-margin cash flow to satisfy shareholders. By the standard metrics of today's fundamental accounting, a company losing over $8 billion a year does not belong in this elite group. Investors are bypassing current earnings to buy into a specific structural pivot. They are no longer pricing this as a capital-intensive manufacturing firm that builds rockets. The first pillar of this shift is Starlink. It has evolved from a satellite internet project into a highly predictable subscriber engine, rewiring global telecom economics and generating reliable, high-margin cash. Here is a flowchart showing the structural setup following a massive all-stock merger earlier this year. In February 2026, the company absorbed Musk's artificial intelligence venture, xAI, hardwiring global data networks directly into bleeding-edge AI models. Building the physical hardware to make that network function is incredibly expensive. The massive scale of the Starship program is still the primary reason for that $8.7 billion net loss. But the market is entirely willing to overlook the hardware costs. Buyers are betting on an omniscient infrastructure play, a monopoly combining commercial space dominance, global telecom, and artificial intelligence. Because the current price relies almost entirely on the promise of future dominance rather than today's profits, holding the stock is an inherently risky, highly speculative play. The volatility is baked right into the model. Even with that immense risk profile, the sheer volume of capital raised in a single day has completely jolted a previously stagnant U.S. Initial Public Offering market back to life. Investment banks are now actively using this massive liquidity event as a blueprint. They are structuring highly anticipated public listings for other tech ventures, most notably OpenAI. Anthropic is also moving rapidly toward following this exact momentum onto the public markets before the end of the year. The market has clearly shown it will ignore massive financial losses right now if the futuristic promise is large enough. The question is whether buying into that promise today represents the ultimate investment of the decade or a $2 trillion bubble waiting to pop.